0. You do the weighted average. You'll find that the expected return on your book is about 180. Then part B says comment on this person's level of risk aversion. Again, just like you should know the person's risk aversion just by looking at their formula. So this person's formula has a 0.5 exponent to the 0.5, so they're risk averse. If it was a 1 or like nothing, because that would be equivalent to a 1, then they're risk neutral. If there's like a 2, then they're risk loving. Okay, so just remember those 3 different like identifying characteristics, I guess. So yeah, B, he's risk averse. You can just look at the exponent. That's it. Then C says calculate the risk premium. So this is sort of like the long answer style question. I don't think it'll be a long answer style question, but I think they might ask it to you as a multiple choice question. But the solving structure is the same. Okay, so step 1 is you want to find the expected return. We already did that in part A, right? Just do the weighted average. We found that it was 180. Then we need to find the expected utility of return. So it's very similar to part A, except now we're just doing like a weighted average of the utility. So we're going to take the income and plug it into a utility formula, right? So our utility formula is I to the 0.5, or square root of I. It's the same thing, right? So for the first part, we get 0.6 and square root of 300. And then for the second part, we got 0.4 and square root of 0. Then we just do the basic calculations. You'll find that the expected utility is about 10.39. Okay, so that's step 2. Step 3 is to plug that expected utility into the original utility equation to be able to solve for like your fixed income equivalent, right? So we take 10.39, we plug that in for U, and then we solve for I. And give me 1 second. And we'll find that I is equal to about 108. So now we know that the utility given by the Gambo scenario of 180, it gives us the same utility as a guaranteed 108. So to find the risk premium, we'll just do the difference between the two. So expected return of 180 minus guaranteed income equivalent of 108 gives you a risk premium of 72. Any questions? Cool. Then we have this. This is the portfolio stuff. Does anybody want me to do it, or can we skip over it? Up to you. Perfect. Yeah, that's what I thought. So yeah, you have the formula. You just do the formulas. Very simple. I'll skip that. Then we have chapter 8. Chapter 8, it's purely theory. Okay, no math here. It's purely theory. So like maybe read through your notes tonight or whatever. Just be familiar with sort of the functions of the financial markets, the differences between debt, equity, primary, secondary markets, exchange versus OTC, money markets versus capital markets. It's just really a ton of definitions. And the only sort of like thinking that you have to do in this problem or in this chapter has to do with like differentiating between the foreign bonds, the euro bonds, and the euro currencies. That's the only thing you have to do. Other than that, it's really just having read your notes and just having a good memory of what the theory concepts are. So question 1, which of the following is most appropriate? So which one is true? What do you think? Okay, so most people are saying the same thing. Most people are saying D, and you would be correct, right? So D says a secondary market is a financial market where securities that have already been issued can be bought and sold. So one of the hangups on this problem is that remember that like a market needs buyers and sellers, right? So if they say just bought or just sold, it's wrong. Okay, make sure that there's buyers and sellers in the question. Secondary market is reselling. It's things that have already been issued. Primary market is for the first time. Long-term debt is capital markets. Equity is capital markets. Short-term debt is money markets. And that's pretty much a lot of the theory that you need to know about this chapter. Very simple stuff. And then here, if you want, I can do it or we can skip it. It's just the differentiation between, the euro bond, the euro currency, and the foreign bond. So if you know the difference between the three, these sort of questions are very easy. So do you want me to skip it or you want to do it?
Skip it.
Perfect. So yeah, here's the answer if you want to take a look at it, but we've covered this stuff before. So that's chapter 8. Chapter 9, again, it's more theory stuff. We're sort of building on from chapter 8. And the main thing that we're adding in here is the different kinds of asymmetric information problems, right? So you got the main three, which you got adverse selection, moral hazard, principal agent. So understand the difference between the three and like sort of what, like when, sort of like what it is, right? So adverse selection happens before you give out the loan. Moral hazard happens after because the person is changing their behavior. And then principal agent is just sort of like a conflict between a manager and a investor because they have different levels of information, right? So those are the three different kinds of the problems, and you also need to be familiar with how to solve them. And then another one that's sort of like a pain in the ass can be the lemons problem. It could be on your exam, it could not be. I have no idea, but it's been on exams in the past. So be familiar with sort of the logic of the lemons problem and sort of be able to work through like what they're willing to pay if they have the same information versus if they don't have the same information and whatnot. So that's pretty much the main stuff of chapter 9. So we'll go one at a time and just indicate if it's moral hazard, adverse selection, or conflict of interest. So part A grocery store pays his employee a fixed wage rate of 10 under the table. The employee decides to take 2-hour-long lunch breaks. So what is the form of adverse or of whatever, of asymmetric information here? What is it? Any answers? Yeah, so this one is going to be moral hazard because again, they've changed their behavior after they've done something. They locked in the wage rate and then they've changed their behavior. So A is moral hazard. B says life insurance company does not distinguish between smokers and non-smokers. They do some research and find that most of the company's policy makers are smokers. This is going to be adverse selection. The reason for that is that they didn't do enough research at the beginning. Then if we look at C, their house is covered by a fantastic insurance policy. Then he leaves for a vacation. He leaves his burner on and he doesn't go home. This is definitely going to be moral hazard. The reason for this is he's changing his behavior after having locked in the insurance. So because he has a good insurance, he's letting his house burn down. So that's definitely moral hazard. And then lastly, D, this is definitely a conflict of interest. And it's because she's getting pulled in two different directions by people, right? She's struggling between, should I do what's best for my company or should I do what's best for me because I'm going to get paid under the table, right? So those are just some examples of the different kinds of asymmetric information. Okay. And this is a good problem for chapter 9. This problem is all about, this is the only quantitative problem for chapter 9. And it's just sort of like, how do we incentivize people to work hard? And it's not hard, this question, but I think it's definitely worth going over. So they'll sort of give you a scenario. If they're lazy, this is the probability of them making this much and this much. If they work hard, this is the probability of them making this much and this much. But then they'll always tack on, the person perceives a personal cost of working hard, so we need to compensate for that. So we're sort of trying to solve like what is the percentage of profits that we need to give them to compensate for that personal value, right? The personal cost. So first, find the expected value of lazy or hard. For lazy, you just look at the table, 0.65 times 50K plus 0.35 times 160K. That gives you an expected value of about 88,500. We do the same thing for working hard. 0.25 times 50,000 plus 0.75 times 160,000. That gives you an expected value of about 132,500, right? But then you'll notice that I tacked on minus 2,000. The reason why I tacked it on is because they perceive a personal cost of 2,000 for working hard, right? So now we have our lazy and our hard equation. Now we need to make them equal each other. And once we make them equal each other, we'll find the percentage of profits that makes them indifferent between the two, right? So 88,500 equals 132,500 minus 2,000. That gives you 2,000 equals 4,400 P. You divide 2,000 by 4,400, you'll find that P equals about 4.54. So essentially what we're saying is that if the owner pays Jordan more than 4.55% of profits, it will incentivize him to work hard. And that is what he should do. That is what she should do. So that was chapter 10. Sorry, that was chapter 9. Then there's also the lemons problem, but I didn't go over it because I've done it before. Yeah, I know. I'm sort of like wheeling through the problems now. I'm talking really fast.
You sound like 1.5.
Huh?
Sound like when you speed up the recording, like
Yeah.
1.5.
Yeah,
but
I know. I'm trying to get through this. Just do it as fast as I can, and then save some time for questions at the end. So then we also got chapter 10. Okay, so chapter 10, it's essentially like small version of COM308, right? You get the main stuff is present value, future value. You got all the different kinds of loans and bonds. So be familiar with how they work, sort of like what their definition is a little bit, I guess. Be able to recognize if a bond is trading at premium, discount, or par. And then the last thing is like the Fisher equation. So make sure you're using the longer version of the Fisher equation and not the simplified version of the Fisher equation, because you'll get it wrong. And there's like the rounding errors. So that's the main thing to worry about that. I don't think chapter 10 is that difficult, especially if you're taking COM308 or if you have taken COM308 or something like that. It's not difficult at all. It's a very simplified version of that. So this question, $900 face value bond has a 9% coupon rate. Its current value is 810. It's expected to sell for 870. So then what is the current yield, capital gain, and rate of return? So how you do this, right? Step one is, I guess you want to find your, actually, well, here they're asking for current yield. So step one is find current yield. Your current yield is going to be your coupon payment divided by your bond price. So we already know our current bond price. It's 810 because that's what it's currently selling at. To find our coupon payment, we'll do our face value times our coupon rate. So 900 times 0.09 gives us a coupon payment of about 81. So 81 divided by 810 gives us a current yield of 10%, right? Then we need our rate of capital gain. So our capital gain is going to be based on like what we bought it at today versus what we're selling it at, what we're selling it at a year from now. So we bought it for 810, we're going to sell it for 870. So our capital gain is going to be price sold minus price bought divided by price bought. So 870 minus 810 divided by 810 gives us a capital gain rate of about 7.4%. Then your overall rate of return on your bond, it's just going to be the sum of your current yield and your rate of capital gains. So we've already calculated those two. So our overall rate of return is going to be about 17.4%. So yeah, again, I wouldn't stress about chapter 10. This is sort of the extent of the difficulty of the problems you're going to have. And your financial calculator, if you have one, it can make some of these questions easier, but it's really not necessary. And that's why they give you more simple questions, because they don't expect everybody to have a financial calculator. And then you got question 20. This is the other sort of chapter 10 problem. If it's not a PV or future value type question, it's going to be one of these Fisher equation questions, right? So they'll give you what they're borrowing, what they owe, then maybe they'll give you like an inflation rate or the real value or the nominal value, and then they'll ask you to solve for the one unknown, right? So part A says, what is the nominal interest rate? You're just going to do what they owe a year from now divided by what they paid for, or like what they received today. Then you're going to tack on the -1 just to make sure it's like the change, like the actual rate instead of like the total return. So you'll find that the nominal interest rate here is about 35%. Then the Fisher equation, it's always the same format. 1 plus nominal equals 1 plus real times 1 plus inflation rate. Okay, so we already have the nominal from part A. We already have the real, we already have the inflation rate, because in the problem it tells us that the anticipated inflation is 10%. So we have nominal, we have inflation rate. Now we just need to solve for a real rate. If we do that, we'll solve for the real rate. It'll tell us that the real rate is about 22.73%. I always like to point out that if you use the other equation, the approximation equation, you get 25%. So just to illustrate that there is a huge difference, and you're going to get it wrong if you don't use the right format. Then for part C, same stuff, same format, right? They borrowed 2,000, but now we need to find out how much they owe a year from now, right? So we have how much they borrowed today. We have the inflation rate, we have the real interest rate. So because we have the inflation rate and we have the real rate, we can use the Fisher equation to solve for the nominal rate. So the nominal rate, once we plug everything into the Fisher equation and solve, we'll find that the nominal interest rate is about 45%. They also gave us the amount she's receiving today. So we can multiply the amount she receives today by 1 plus the nominal rate, and it'll give us the amount she owes in a year from now. So she owes about $2,904 a year from now. So that's sort of the extent of chapter 10. Okay, so now we've done, I think, everything that was on the midterm. Midterm 1 and midterm 2. So from here on out, it's all going to be new material. So I'll probably go a little bit slower starting now. So now we have chapter 11. So chapter 11, it's really all about like what determines asset demand, what determines bond demand, what determines bond supply. So it's understanding like what is driving these demand and supply forces. Okay. Then you also have the two other things that you need to remember is the equation of like bond supply plus money supply equals bond demand plus money demand, because you can only hold the two. So that's where that equation comes from. You need to hold either one of the two. Then you also need to understand the last thing would be like the strength and speed of liquidity effect versus other effects. So I think there's a pretty high likelihood that you get like a multiple choice question on that. But overall, chapter 11, you're not going to get a long answer question on this. So the demand and supply functions for 1 year. Okay. Yeah. Okay. So the demand and supply functions for 1 year discount bonds with a $1,000 face value are the following. So you have your PD, you have your PS. They say to calculate the equilibrium price and quantity of bonds in the market. So how you're going to do this is you're going to make your PD equals your QS, your PD equals your PS. So you do that, negative 0.5 Q plus 1300 equals Q plus 250. You send 1300 to the right, you send Q to the left. Then you take off the negatives, and then you divide 1050 by 1.5. You'll find that Q star is about 700. You take that Q, you plug it back into your QS or your PS or your PD, and you'll find that your P star is about 950. Okay, so now you have your two equilibrium points. Part B says, suppose the Bank of Canada purchases 100 bonds in the market, effectively removing them from circulation. What is the new bond supply equation? So we need to understand like how that $100 removal is going to impact the PS equation. So I like to convert it back into the QS format because I think it's more intuitive. So so I just went from PS to Q equals PS instead. You don't really have to, but I think it's more intuitive in understanding what's happening. So our quantity equation is Q equals PS minus 250. And then we say that they remove 100 from circulation. So that's why I'm going to tack on a negative 100. So I'm going to go from negative 250 to negative 350. And then I just converted it back into PS just for comparison basis for C, right? So my new PS is going to be PS equals Q plus 350. C says, what is the new equilibrium price and what impact would this have on interest rates? So I'm going to take my old PD and my new PS, and I'm going to make them equal each other. So negative 0.5 Q plus 1300 equals Q plus 350. So I'll send the 1300 to the right. I'll send the Q to the left, and then I'll take off the negatives, and then I'll divide 950 by 1.5. So that'll give me a Q star of 633.3. And then I take that Q and I plug it into the PD or the PS, and I'll find that my P star is about 983.3. So now we have our two equilibrium points. And I think they were asking like what happened to interest rates. So the price of the bonds before it was 950, now it's 90, now it's 983. So the price of the bonds went up. That means interest rates went down, right? So you can clearly see that because price and interest rates have an inverse relationship, and you can see that the price went up, therefore interest rates went down. So you can sort of see that, and also intuitively, like if bond supply went down, money supply is effectively increasing, so that would also drive up the interest rate, and that just sort of has to do with like this function. But you don't necessarily need to look at this function. You can also just see like literally the price went from 950 to 983. So that's another answer to the question. Okay. So which of the following factors would shift the money demand curve left? What do you think? Any answers? So you got some A's, you got some C's. The answer is going to be C, right? So C says a decline in prices. If prices go down, I still want to buy the same amount of stuff. I need to hold less money in my wallet to buy the same amount of stuff. Therefore, the money demand is going to go down. So it's going to shift to the left. Then A said a rise in wealth. A rise in wealth would actually shift my money demand curve right, because if I have more money, I want to spend more money, I want to buy more goods. Therefore, I need more money in my wallet, right? So that would shift money demand to the right. So yeah, that's why C is the correct answer. Then you got question 9. This is just sort of a question to make sure you understand like how the different factors are influencing asset demand. So what do you think the answer is? Read it and type it in the chat. So most people saying D, and you're correct, right? Liquidity is a good thing. So more liquidity drives asset demand up. Wealth increases your amount of money. So I'm going to buy more assets. So asset demand goes up with wealth. Risk is a bad thing. So if risk goes up, asset demand is going to go down. And then lastly, expected return. People want higher expected return. If expected return goes up, demand goes up for bond. The demand for assets goes up as well. So that is why D is correct. So now we get some real new stuff, I guess. So chapter 12, some of the main stuff from the chapter is really like the different kinds of the 3 different theories, right? So, or the 4 different theories, I guess you could call it. And it's the ones down here, right? You have the expectations, you have the segmented markets, and you have the liquidity premium theory. So you need to understand the difference between the 3 theories. And then you also need to sort of know the formulas that you need to calculate the spot rates and forward rates and that kind of stuff. So that's the main stuff from chapter 12, I would say, is the 3 theories. Now for some questions. So question 9, the following table gives you the current and expected future 1-year interest rates, as well as the rates for multi-year bonds. Calculate the liquidity premium for each multi-year bond. So they give you a table, and they tell you your individual 1-year rates, and they also tell you like your multi-year rates. Okay, so you got a question. Can I see chapter 12 concept page again? Yeah, of course. Yeah, no worries. So you have your 1-year rates, and then they also give you your multi-year rates. And you need to pay attention to like if they're telling you to operate under expectations or like liquidity or whatever it is. So in this problem, they're telling us to operate under liquidity premium. Like they speak about a liquidity premium, therefore we're operating under like liquidity preference format. Okay, so the liquidity premium is going to be the difference between the multi-year bond rate and the average of the 1-year bonds for the same period. So the average of the 1-year bonds for the same period would be the expectations theory. And then because we're liquidity premium theory, we need to tack on that premium. Okay, so for year 1, your 1-year bond rate and your multi-year bond rate is the same. So obviously there's no liquidity premium there. So it's going to be 0. And if we look at year 2, the multi-year bond rate is 2.5. Okay. But then if we look at the average of the 1-year bond rates that make it up, in year 1, you have 2, in year 2, you have 2. So 2 plus 2 divided by 2 gives you 2. So the difference between 2.5 and 2, it's about 0.5%. So that's our liquidity premium there. Then if we go to year 3, we have 3.5 as a multi-year bond rate. Then we need to do the average of the 1-year bond rates. So 2 plus 2 plus 3 divided by 3. And then we do the difference between 3.5 and that. And you'll find that it's about 1.166. Okay. Then we do the same thing for year 4, 4.5 minus 2 plus 2 plus 3 plus 3.5 divided by 4. You'll find that the liquidity premium is about 1.875. Any questions? Cool. Yeah, I'll go back real quick. Yeah, no worries. So question 12, suppose you observe that the spot interest rate on a 1-year investment is 8%. Further, suppose you observe that the spot interest rate on a 2-year investment is 8.995. Calculate the forward rate. So calculate the forward rate on a 1-year investment given this information. So the formula that you're going to need to use, it's 1 plus y1 times 1 plus f2 equals 1 plus y2 to the power of 2. So that's the formula. So y is your spot rate, f is your forward rate. So just make sure that you're differentiating between like spot rate and forward rate, and also like understand that like the 2-year forward rate would be the 1-year bond rate that I would receive 2 years from now. So F2 is the 1-year bond rate I get 2 years from now, versus Y2 is the 2-year bond rate I get today. So know the difference between F2 and Y2. So yeah, so that's the format. Now we just got to plug in our Y1, F2, and Y2. Okay, so they tell us that the spot interest rate on a 1-year investment is 8%. So Y1 is going to be 0.08, or sorry, 8%, right? Then they tell us that the spot rate on a 2-year investment is 8.995. So that's going to be Y2. It's a spot rate on a 2-year investment, so it's F2. If they told us the spot rate, if they told us the forward rate on a bond in 2 years or something like that, that would be F2. So just pay attention to the words. So we're going to plug in 1.08995 as our 1 plus y2. Now we just do the basic math, right? We put 1.08995 to the power 2. We divide by 1.08. That's going to equal 1 plus f2. So 1 plus f2 is about 1.1. You take off the 1, you'll get f2 is about 10%. Okay, so that's just sort of the structure of those questions. So that's chapter 12. Chapter 13, this is like chapter 13 and 14 are pretty similar. It's starting to talk about like global trade and like trade to GDP ratios and understanding the difference between, you know, shallow versus deep integration, understanding the benefits and disadvantages of trade and whatnot. So chapter 13 is more theory based, and then chapter 14 is more the calculation based of comparative and absolute advantage. But still, chapter 13 is important, just more on a theory level. So question 6, consider the following 3 statements and choose all that apply. Yeah, so I'll explain that real quick. So Y2 is if today I am buying a 2-year bond. So Y2 is today I buy a 2-year bond. Y3 would be today I buy a 3-year bond. Y4 would be today I buy a 4-year bond, right? So Y is spot rate. Y2 means the spot rate of a 2-year bond. Okay. F2 is the rate that a 1-year bond is anticipated to be in the future. So F2 would be the 1-year bond rate expected to prevail 2 years from now. F5 would be the 1-year bond rate expected to prevail 5 years from now. Does that make sense? Sorry, your Y2 is kind of like your N of the bond. No, well, N is the number of payments. I over Y, maybe you mean? It's, yeah, so yeah, the Y2 would be like the I over Y, versus the F2 is, as I said, you know, the expected 1-year rate to prevail X amount of years down the line. So F2 is the forward rate, Y2 is if I can lock in that today. Yeah, no worries. So question 6, consider the following 3 statements and choose all that apply. So take a look at them, tell me which ones are true, which ones are false. And the answers for true and false. Okay. So you got some people saying B, some people saying D. Let's take a look at what the answer is. The correct answer is B. Okay, so B is saying 1 is true, 2 is false, 3 is false. So 1 says there are gains from international economic integration. So this is true, right? This is just, I mean, there's nothing more to say. It's a very good thing. Like you gain access to more technology, you can specialize in things like that. So there are some gains from economic integration, international economic integration. So 1 is true. B says, or 2 says, on average, deep integration is followed by shallow integration. This is definitely false. The reason for this is that shallow integration is only economic versus deep integration is economic and political. So deep integration is a lot harder to achieve. Therefore, it's going to happen after shallow integration. 3 says multilateral organizations are associated with deep integration only. This is going to be false, right? Because multilateral organizations have to focus on both political and economic issues. So that's why they have to work on both deep and shallow issues. So that's why 3 is false. Question 7, which of the following is not a benefit of international integration? What do you think? Any questions? Oh, sorry, any answers? Which is not a benefit? You got somebody saying E. So the correct answer is D. Okay, D is not a benefit. So D says the efficient capital flows make financial crises harder to spread. So that's actually false. Okay, the efficient capital flows actually make it easier to spread. So that's why D is not a benefit of international integration. Then if we look at some of the other ones, A says it gives consumers options, more choices at lower prices. That's true because everybody can specialize and you can get goods that maybe are seasonal usually, but you can get them in your country at different times. B says capital flow make funds more accessible to investors. That is also true, right? More developing countries can get access to, like American companies investing there and whatnot. C says migrants obtain higher incomes while firms benefit from low labor costs. That's true. People who move to the US, for example, from a developing nation, they get paid much more on an hourly basis, and maybe the firms can pay a little bit less. Then E says international transaction costs are on the decline. That is also true, just to like the advancement of technology and stuff. So that was 13. Now we have chapter 14. So chapter 14, like we just covered it earlier today. It's really like all about, the main thing you want to know here is the gains and losses from trade calculations. Yeah, you want to see D? There you go. So the main thing from chapter 14 and something that I'm pretty certain that you'll have a question on it, a long answer question on it. It's, gains and losses from trade calculations. I think that's a very important part of the chapter and probably a big part of the exam. Then also just be able to distinguish, between absolute and comparative advantage, understand like what the PPC is and how you can get the CPC from the PPC. Understand some of the assumptions from the Ricardian trade model, because they might ask you to point out some of them in one of the multiple choice questions and whatnot. So yeah, that's the bulk of chapter 14. So question 3, suppose Canada and the United States are preparing for trade, bread and steel. The United States has the comparative advantage in the production of bread and thus will export the loaves. The two countries have agreed on a relative trade price of 2 loaves of bread for 1 ton of steel. Which of the following is true considering this information? So what do you think? Take a look and give me an answer. So you got somebody saying A. Any other options? Okay, let's take a look. The correct answer is E. So I'll work through why some are true, some are false. Okay, so E says the opportunity cost of steel must be fewer than 2 loaves of bread. So the reason why this is true is that in the problem, they say that the two countries have agreed on a relative trade price of 2 loaves of bread for 1 ton of steel. Okay. And they also say that the United States has the advantage in bread, and if US has the advantage in bread, therefore Canada has the advantage in steel. Okay. For Canada to agree to trade a ton of steel for 2 loaves of bread, they would only agree to that deal if it was beneficial for them. And the only way it would be beneficial for them is if the opportunity cost of steel is fewer than 2 loaves of bread. So it's like essentially saying like, we've agreed willingly to this trade. We've told you this trade price. They would only agree to this trade price if it was profitable for them. Therefore, their opportunity cost for bread must be fewer than 2 loaves of bread. The opportunity cost of steel must be fewer than 2 loaves of bread. So that's why E is true. Then if we work through some of the other ones, A says the opportunity cost of steel in the US must be fewer than 2 loaves of bread. So the reason why this is false is that the opportunity cost of steel should be above 2 loaves of bread. Otherwise, it would reap no benefits trading with Canada at a relative trade price of 2 loaves. Yeah, so if they could make bread, if they could make steel for less than 2 bread, they wouldn't accept that deal. They would just decide to produce it for themselves. Okay, so that's why A is false. B says the opportunity cost of steel in Canada must be equal to 2 loaves of bread. It's false because it doesn't have to be equal to that. It's always a range, right? So it doesn't have to be equal. It just has to be less than 2 loaves of bread. Okay. C says the upper and lower bounds of the barter prices must be 0.67 and 1.5. So there's not enough information in the problem to calculate the upper and lower bounds. To calculate the upper and lower bounds, we would need to be able to calculate the opportunity cost for both countries, and then it would settle between the two. But they didn't give us like a table, so we don't have enough information to calculate those opportunity costs. Therefore, like we can't say specifically that this is the bounds. And we definitely know that the upper bound is not 2. Okay, we know that the upper bound should at least be 2 because the trade price was 2, so that makes absolutely no sense that it would be between 0.67 and 1.5. Then you have D. D says Canada can never gain from trade in any instance of this scenario. This is false because, as I said before, like if you're engaging in trade, it's voluntarily, and you would only voluntarily engage in trade if it was profitable. So because they've told us that these companies are engaging in trade and you would only do so if it was good for you, we know that they can benefit from trade. Question 15. So this is a sort of another example of a good question that I think will be asked. Like they'll give you a table, 2 products, 2 countries, same as usual. Then eventually what you'll be asked to do is like sort of calculate the gains from trade. And that's part D of this question. But here we also have parts A, B, and C, which are just used to sort of build your understanding and build towards part D. So part A says which country has the absolute advantage in wine. So you just look at the one with the higher production of wine. This could definitely be a long answer question. I think for sure that this is a long answer question, in my opinion. I think for sure you're gonna get a long answer question from 14, exactly like this, and then a long answer question from 15 about like the currency exchange, and like I'll convert my Canadian dollars to US dollars, and then I'll invest in US and things like that and calculate the arbitrage. I almost guarantee you that you'll have those two as 2 out of your 4 long answer, and then the other 2 out of the 4 will probably be from stuff that was on your midterm and midterm 2. So yeah, this is important. So yeah, which country has the absolute advantage of wine and whiskey? So you just look for the one that has the higher number in each. So for wine, Scotland has a higher number. For whiskey, Scotland also has a higher number. So Scotland actually has the absolute advantage in both products. Okay. Part B says which country has the comparative advantage. So comparative advantage, we're going to need to dig deeper. We're going to have to calculate the opportunity cost. So the opportunity cost Let's do it for whiskey first. So for whiskey, Scotland has to give up, actually, yeah, let's do whiskey first. So for Grapeland, for whiskey, they need to give up 3,000 wine to make 1,000 whiskey. So the opportunity cost of whiskey is 3,000 divided by 1,000, it's 3, okay? Then the opportunity cost of whiskey for Scotland, they only need to give up 5,000 wine for 10,000 whiskey. So 5,000 divided by 10,000, that gives you an opportunity cost of whiskey of about 0.5 for Scotland. Okay. So that's why Scotland has the advantage in whiskey. Then if we do the same thing, but the math for the wine, Grapeland only has to give up 1,000 whiskey to make 3,000 wine. 1,000 divided by 3,000 gives you about 0.333. So that is the opportunity cost of wine for Grapeland. Then we do the same thing for Scotland. 1,000 whiskey divided by 5,000 wine. That gives you 2. Okay, so 2 is the opportunity cost of wine for Scotland. So you can clearly see that Scotland has the comparative advantage in whiskey and Grapeland has the comparative advantage in wine. Then for C, what are the upper and lower bounds for the trade price of whiskey? You're just going to need to look at the opportunity cost of whiskey for both countries. So the opportunity cost for Scotland was 0.5. The opportunity cost for Grapeland was 3. So somewhere between those two is going to be the trade price. So the upper bound is 3, the lower bound is 0.5. Part D, if the two countries decide to trade 100 liters of whiskey at a rate of 2 liters of wine per liter of whiskey, what are the gains from trade? So first we need to say like who's specializing in what. So we know that Scotland is better at making whiskey and we need to make an extra 100 whiskey. So Scotland is going to specialize in whiskey. They're going to make that extra 100 whiskey. Then they also tell us that the trade price is 2 liters of wine per liter of whiskey. So we're going to need that for later. So if Scotland decides to make 100 extra liters of whiskey, they're going to have to give up some amount of wine. Okay. They're going to have to give up 50 liters of wine. And how we found that was based on the opportunity cost and just looking at the table, right? So to make 10,000 whiskey, they give 5,000 wine. So that's an opportunity cost of 0.5. So you multiply 100 by 0.5. That tells you that they will give up 50 liters of wine to make that 100 liters of whiskey. Then they're going to take this 100 liters of whiskey and they're going to trade them for 2 bottles of wine each. Okay, so if they take 100 whiskey and they sell it for 2, that means they end up with 200 liters of wine. The net gain is going to be the difference between what they actually received, which was 200, and what they had to give up from like an opportunity cost of basis, which was 50. So 200 minus 50 is 150. So they have a net 150 gain in wine. Then if we do the same thing for Grapeland, Grapeland is going to produce 100 less whiskey because they know that they're going to buy